All right, I want to welcome everyone to Legacy Wednesdays, Fire Through Real Estate. Each week, we're going to bring to you a different webinar and educational content on how you can become a smarter passive investor and how you can achieve FIRE, which is financial independence, retire early through real estate investing. Today's topic, we're going to discuss how to secure your retirement with passive real estate investments. So we're going to talk about passive income, how to get started, how you can use it to build cash flow, and then how you can use it to improve your retirement. Not have to rely on the volatility of Wall Street and not have to rely on one single investment vehicle, such as a 401k or the equities market. So we're going to go ahead and get started. First of all, I just want a quick disclaimer. This webinar is for educational purposes only, and it should not be considered legal or investment advice. Obviously, we always recommend that you consult an attorney, a financial advisor, or a CPA for any legal matters before you make any type of investment, just to be safe. All right, so what is FIRE? Before we jump into the meat and bones of the content, what is FIRE? What is this webinar? What is Legacy Wednesdays? FIRE is an acronym for Financial Independence, Retire Early. We are all on a mission here at Headway Capital to help you achieve FIRE, to help you achieve financial independence so that you can retire early. We do that by providing private passive investments in commercial real estate opportunities and by educating you with content such as this so you can become a smarter investor, a more savvy investor, and ultimately a more confident investor. It's really important that when you make an investment, you're really confident in it. So that's our goal with this webinar today, and we hope this webinar helps you achieve financial independence. Just a real quick run through of who we are here at Headway Capital. Our company, Headway Capital, was designed to build and protect the wealth of busy professionals. So we want to provide you with investment opportunities that give you the freedom to do what matters most. So if you like to work, great. If you like to travel and vacation, great. If you like to do things with your family, great. We want to give you that financial flexibility by providing you with cash flowing investment opportunities. So our team has extensive experience sourcing, vetting, and investing in alternative investments through various market cycles. So we've been around since Sid and Nam have been investing since 2011. I got into the real estate investing space in 2018, and Headway Capital was started in 2018, along with Headway Properties, our vertical property management wing. I'll share my story, real quick background on me before we get started. As I mentioned, I started investing in real estate in 2018, jumped into the single family space because that's what I thought was best. And that's all I knew. All the books I was reading on real estate investing, all the podcasts I was listening to, all the webinars I was attending, a lot like this one. We're all preaching buy rental houses, use the BRRRR strategy, flip houses to build income, and and then go from there. Well, I did that for about a year and a half before I quickly realized that I essentially bought myself a job. I was able to accumulate a few houses and really quickly realized that all the cash flow, as I like to say in quotes, cash flow that I was getting from those houses was going right back into those houses. I would make, let's just say, $500 a month in cash flow, in profit, so to speak. Times 12, that's $6,000 a year. Well, at the end of that 1 year lease, my tenant would move out and I would end up spending that $6,000 on repair and make ready. So I quickly learned that if you were going to build wealth, the best way to do that was by getting into commercial real estate. The formula for creating wealth is much different. I still love the residential asset class. I think it can be great for a lot of people. It just wasn't for me as a busy professional at the time. Started investing in commercial real estate 2020, right around the time COVID was starting. I worked at a small boutique private equity firm, helping source very similar investments that we have here at Headway, and then transitioned over to Headway Capital earlier this year. And I'm excited to lead these types of webinars and educational content. Sid started investing in 2011. Like I mentioned, him and Anam accumulated a portfolio of a little over 30 houses. And just quickly realized too, after investing for a few years, that it was a full-time job. They got the cash flow. They were getting the balance sheet improvements by buying those houses, but they wanted to grow, so they transitioned into multifamily. First thing they started doing was passively investing, which we're going to talk a lot about today. It's a great way to get started if you ever do plan on becoming an active investor. And I guess you can say the rest is history. Just to go over a little bit about our portfolio and our track record. Since inception, Sid and Anam and us over at Headway, we have about $539 million of assets under management, which is a little over 3,000 units. And we really look for deals that provide a 7 to 10% average preferred return to our investors. And we want to double our investors' money in 5 years. That's our goal. So 20% being the downside or the low side on an average annualized return. But we really try to look for deals that are a little bit more juicier than that, so that our investors can get anything above 20 is great. So, but 25 to 30 is really what we aim for. Our secret sauce, just to cover real quick, every week I like to talk about this. I won't talk too long about it, but we are super focused. We're purposeful in all the work that we do, and we're very disciplined. And we believe doing this over a long period of time consistently will produce results. This is our secret sauce and what separates us from other syndicators, or from other investment firms, or from other real estate, people that have real estate firms. Is we stay focused, we stay diligent, we say no to a lot of things, because if it doesn't align with our values and our principles here at Headway, and they don't provide returns to our investors, we don't want to do those types of deals, right? And our goal is to produce results and to make no excuses along the way. We have different types of opportunities that we offer in apartments, service businesses. We have a real estate debt fund, and we occasionally offer car washes when we find good opportunities as well. Talk more about that a little at the end. Let's dive into the meat and potatoes of this webinar. Why are you here? We're here to talk about how you can create wealth and cash flow from passive real estate investing. So I want to start this conversation by asking you a question. Do you know your passive investing principles? What are your principles that help you say yes or no to a deal? And you need principles to mitigate risks and guide your investing decisions, right? Our goal, our number one goal as investors, and I'm not just talking about Headway, I'm talking about even me, myself as a personal investor for my portfolio, is to mitigate risk and to never lose money. We want to make money. Of course, that's our goal. We're all here to make money. We invest to make money. We don't invest just because, but the first rule of thumb is never lose money, right? And the goal is to mitigate risk, and having these principles lined up before you even get started, before you make your first passive investment, before you make your next passive investment, or any investment, even if it's in the equities market or any type of other projects, you need to have these principles lined up. So I want to cover these principles, and we have 4 principles. I call them the wealth building principles that I really like to recommend to our investors that they try to follow when they're looking at deals. So when they're looking at real estate deals, when they're looking at commercial real estate deals in particular, do the deals check these 4 boxes? And so let's go over those today so that you can be a little bit of a smarter investor the next time an investment opportunity presents itself, to see if it checks all 4 of these boxes, or maybe 2 of the boxes, or 3 of the boxes, which can help determine if it's a good deal for you. So let's go over these. So what are the 4 wealth building principles? Well, the first one is capital preservation. We're going to dive deep into capital preservation. The second one is cash flow. I put here cash is king, because that's a kind of a funny saying you've probably heard before, but it is so true. Cash is king, right? Or cash flow is king. I should have put on here. If it doesn't cash flow, is it right for you? That's a really big question you have to ask yourself when making an investment decision, right? Equity appreciation. Does this asset class, does this real estate investment that I'm investing in, can I force the value of the asset up? Or can the partners that I'm partnering with force the value of this property up? That's a big question you have to ask yourself when investing in real estate, right? Not every deal has forced appreciation opportunities. And then the last one is, what tax implications does this type of investment have? Every investment's different. The tax implications on a stock investing, or a REIT, or a 401k, or any of those other type of vehicles can be very different than what you get in a private passive investment opportunity. And every deal is different. Some deals have different tax benefits compared to others. So it's really important you understand that going in. So let's dive in to the first one. Let's talk about capital preservation. I highlighted here, never lose money. This is the number one thing. I put this on here first because to me, it's the number one goal. You should never lose money, right? Nobody wants to lose money when they're investing. That's really, really, really important. So that's rule number one. But how do we preserve our capital, and how does this play into real estate? Well, first of all, real estate is a great capital preservation tool because it's collateralized by something hard, right? It's a hard asset. It's a physical building. You can see it. You can touch it. It's tangible. That's much different than, say, investing in a stock. in an equities, in a REIT, in a company, essentially, it's not collateralized by anything. All you have is your digital paper saying that you own a percentage of that. And there's usually no thing you can go and touch and say, like, this is my building, I own it, right? So it's collateralized by a hard asset, which is great. Hard assets don't just disappear. Stocks can go to zero. Buildings don't magically disappear. So while there's still risk involved, it's very unlikely that you just lose all your principal in types of investment. Of course, it can happen. There are risks involved, but it's not as common as saying buying a stock and kind of praying or crossing your fingers that it goes up when maybe it ends up going down, right? Due diligence is conducted by experts. So this is really important. When you're picking a stock, you have to often do your own due diligence, or maybe you have a financial advisor or wealth advisor that helps with these types of decisions. But in the real estate space, a lot of the due diligence that's conducted, if you're a passive investor into these commercial real estate deals, they're done by experts, right? So when you're looking at a deal, if Headway presents a deal to you, whether it's a multifamily deal, a car wash deal, or whatever type of project it might be, you can trust that there's been some due diligence conducted by experts. And by experts, I'm not just talking about us over here at Headway. I'm talking about third-party people that are all looking at this project to see if it actually has the potential to meet the business pro forma, to meet the business projections that we're putting in front of the lender. We're putting it in front of our tax professionals. We're putting it in front of property managers to say, hey, can we get these rents? And then we're ultimately, once it checks all the boxes, we're putting it in front of investors saying, we've thoroughly vetted this deal. We've looked at it. Our lenders looked at it. The banks looked at it. All these experts have looked at it and say, hey, they like this deal. They feel like this business plan can happen. That's harder to find outside of real estate, right? You don't get a lot of insight from experts. Also, from a capital preservation standpoint, it's, commercial real estate deals, passive investing deals are shielded from the volatility of Wall Street. Now, everything can go up and everything can go down. It's not to say that real estate never goes down. We all know what happened in 2008. We've seen some softening in the market over the last 12 to 18 months. I wouldn't call it a major correction, but we've seen some prices coming down. They skyrocketed at 30, 40%, and now they're coming down 5 or 10%, but they're still up there. If you go up 30, 40%, you come down 10, you're still up, positive 20. But you're shielded from the volatility of Wall Street, right? So it's very unlikely, or the formula doesn't work the same way where, if a bad article comes out, stock can go down very quickly. If an earnings report comes down, the stock value can drop very quickly, almost too quick, where you don't have time to react. You don't have time to tell your wealth or financial manager there's time to sell. You don't have time to sell yourself if you're managing your personal portfolio. Well, you're shielded from the volatility of Wall Street, investing in hard assets, investing in commercial real estate. And because these are long-term investments, you don't have to overreact when something happens. So if there is a softening in the market or a slight downturn in the market, well, these are 5-year investments. You've got some time to potentially allow the deal to catch up, right? And the last one on here, and how real estate and capital preservation go hand in hand, is it's important to understand that the assets are valued based on NOI and not on comps or market sentiment, right? So back to talking about Wall Street, there's no market sentiment when it comes to real estate. It's the numbers, right? What's the NOI? And then what's the market cap rate? Now, the market cap rate can fluctuate based on things like interest rates and supply and demand, but you ultimately have control over that top number, which is the NOI. So if you're a good operator and you're collecting rents, you're renovating units, you're cutting expenses, you have some influence over the control over the value of the asset. There are not a lot of asset classes where you, as the operator, as a partner in these deals, can say that you're partnered with somebody who has control over the value of this property, right? So, or of this asset type. You can't do that in Wall Street. And then it's limited in an asset class such as like single family residential real estate, right? In residential real estate, you have market comps. And if the value of your house is based on market comps, $300,000, well, it doesn't matter if you're collecting $5,000 in rent, which means your NOI is really high, net operating income is really high. The house is still worth $300,000, even though you're collecting $5,000 in rent when maybe market rent is, say, $2,000, right? Well, commercial real estate's the opposite. It's based on the NOI. So if you're collecting a really healthy, high dollar amount in rent, you divide that by the market cap rate, and it's going to help show you how you can really improve the value of your property. So it's a great tool for capital preservation in this sense. Cash is king, or cash flow is king, as I mentioned. So there's a saying, I don't know who said this, but it's always at the top of my mind. I like to repeat it. Cash flow can help you retire, and equity can make you wealthy, or equity can make you rich. So it's really, really, really important, in our opinion here at Headway, that you're really seeking opportunities that have cash flow. Now, not every commercial real estate deal is going to have cash flow. If you invest in a new construction project, well, there's no cash flow. There's nobody renting the property. How are they supposed to pay dividends to their investors? They can't. If you invest in a land deal, let's say you're doing a land flip where we're going to buy some land, we're going to get the land ready for shovel ready. There's no cash flow. There's nobody on top of the property. Nobody's building anything. There's no dividends to share, right? So it's really important, in our opinion, that if you're seeking financial freedom and you want to retire early, you need to invest in cash flowing properties, right? You need to invest in things that actually generate revenue. Well, how does cash flow play into real estate? Well, first of all, in commercial real estate, you're getting multiple income streams, which is really, really, really different compared to, say, residential real estate, right? Or maybe like a stock you invest in that pays a quarterly or annual dividend, right? You're getting monthly income from these units. So every apartment is paying rent. If you're in triple net or retail, every tenant is paying rent. If you're in self-storage or mobile home parks or RVs, all that stuff, people pay rent on an ongoing basis. There's multiple income streams and multiple units, which ultimately ends up mitigating risk. So that's something that's really important when it comes to real estate. You have the ability to improve cash flows, right, with renovations and other income and expense cuts. I talked about that a little bit already, but we can actually, as we acquire the property and the longer we hold on to it, we can actually improve the cash flow. And ideally, I will say most of the time, when you're looking at pro formas and when you're looking at financial projections and you're looking at the cash flow dividends that we pay to our investors, they usually ramp up as we hold the property, depending on if there's a cash out refinance. But year one, you might have a 5 or 6% cash flow. Year two might be 6 or 7, 7 or 8, 8 or 9. And as you're kind of working your way up to hopefully close to 8 to 10% cash flow on an annual basis as you get from year 3 to year 5. But you have the ability to improve your cash flow. Well, how do you do that? You can renovate units. You can increase rents to market, right? If maybe you're buying, ideally, we're looking for properties that are severely under market rent. Market rent is $1,000. The rents there are $700 or $800. Well, we have a $200 or $300 delta at that point to improve rents. Of course, we have to renovate the units and we have to improve customer service, and there's some amenities we might need to change or add. But we have that ability to get to market as long as we do our job, right? And we can also generate other income. We can go out there and we can charge pet fees. We can implement an application fee. We can add an amenity fee. We can add covered parking. We can add reserve parking. We can do valet trash. There's a long list of other income items that we can layer onto a property to improve the overall cash flow. And then finally, it's our job as fiduciaries of our investors' capital to make sure we're wisely spending money and we're cutting expenses, right? So sometimes when we buy properties, they might have fat expenses. They might have things that they're overspending on. That could be things like landscaping. That could be things like water bills. We can do water implementation programs where we try to cut the water expenses. There's a lot of different ways to cut expenses at a property, but that's our job, and we can improve the cash flow by doing that. Cash reserves also protect the asset from being lost, which is just another thing that's really important when you're investing in these commercial real estate deals. Really good commercial real estate operators or commercial real estate partners, and this is a question you always want to ask, whether you're investing with us or you're investing with another partner, is what type of cash reserves do we have going into the project, right? That's crucial because in today's environment where you've got rising interest rates, you've got costs that are just exploding. Insurance costs are exploding. Taxes are exploding. Labor costs are exploding. Things are much more expensive 2 years ago, 2 years from, than they were 2 years ago. So you have to make sure you have cash reserves to weather a rainy day. That's what we like to say. You want to have a rainy day bucket. Cash reserves can protect the property from being lost, right? So if you have ideally hundreds of thousands of dollars just sitting there, it never gets touched unless it's absolutely needed for a rainy day. That can help protect the cash flow on the property, and it help protect us needing to go back to our investors and say, hey, we need more money, or hey, we're going to lose the property, right? Really important. And then the last one here that I'll make on cash flow is we have the ability to adjust the rents to combat inflation. And this again goes back to why it's so beautiful to invest in commercial real estate, is because there are levers we can pull depending on what's going on in the economy, what's going on in the market to try to combat inflation. I'm not going to say that it's one for one. So inflation has obviously been sky high over the past 2 years, really. So if inflation's at 5 or 6%, we might not be able to raise rents 5 or 6% to keep up, but we can try to get really close, which is going to help cover some spread and cover some losses, right? So if inflation's 6%, well, maybe we're pushing rents 4%, maybe we're pushing rents 5%. We're still, maybe down 1% or 2% based on how high inflation is, but we're at least doing our best to combat inflation. We're fighting inflation to the best of our ability, and that's really hard to do in other types of investments. Let's move on and talk about equity appreciation. The third thing on the principles, the 4 principles for building wealth through passive real estate investing. The question you need to ask yourself when you're evaluating these deals is, can you force the value of the asset up, right? Can this property, can this asset, can the value be forced? We already talked about how residential real estate has a ceiling. You can only renovate the property so much based on the comps, right? So how does this play into real estate? How do you force the value into real estate? Well, the first note I want to make here is that time is your friend in real estate, right? We're going to deal with market appreciation in the right markets. So the longer we hold a property, ideally, as long as we're buying the right properties, we're doing the right renovations, we're operating them well, and then we're buying in the right markets, the markets will appreciate over time. I don't know anybody personally that has bought real estate 5, 10, 20 years ago and said, hey, my property went down in value. If they were buying in a good market, they were buying in good school districts, they're buying quality assets and then taking good care of them over time. It's extremely rare. Real estate over a long period of time the time is on your side, right? So we got to make sure we're buying in the right markets to get that natural, what we call organic appreciation. Organic appreciation is where the market's just naturally going up over time because people are moving there. The demographics favor that market. The economics and the economy and the job growth in that market are favorable. So there's natural market appreciation. There's organic rent growth. There's organic population growth. Those are the deals we want to invest in. You're going to get natural equity appreciation, right? And as I've got to keep killing this dead horse here, or beating this horse to death here, is we're going to get forced appreciation with the right business plan. So it's super crucial that you're investing with the right operators that have the right business plan. Because if you don't have the right business plan for the right property, well, a good property with a bad business plan could be a bad deal, right? So it's really important that the business plan aligns with the type of property and aligns with the demographics and the other comps in the area. If we're able to do that, well, we can force appreciation, right? We can improve the NOI, like I mentioned. We can go in there and renovate units. We can improve customer service. We can make the residents' lives so much better where they're comfortable in renewing their lease and paying an extra $50 a month, an extra $100 a month, just naturally, without even having to renovate their unit because they're getting better service. The property's cleaner. They're seeing new amenities inside the property. The gym equipment gets replaced. Just all the little things that people really appreciate, right? So we want to get that forced appreciation. And the last comment I'll make when it comes to equity appreciation is we want to leverage debt to maximize our investors' returns, right? I've gotten asked the question before, well, how come you don't pay cash for all these properties? And the quickest response to that is leverage or debt, when used responsibly, is an investor's best friend. It allows us to maximize our investors' returns. These are $20 and $30 million properties. Well, if we were to pay cash for them, of course, that mitigates some risk because you don't have debt risk, right? And you're going to have good cash flow because there's no bank payment to make. Well, but you're not going to be able to maximize your returns, right? You're not going to be able to maximize your internal rate of return, your IRR. You're not going to be able to maximize your average annualized return, and you're going to have to hold the property longer in order to get that return back, which is not what we're aiming for here. So we want to make sure we're leveraging good debt and good loan to cost. We don't want to over leverage, right? We don't want to take out a note that's 80 or 90%. That's too much leverage, especially in today's market. We want to leverage responsibly. We want to be in that 60 to 75% range, ideally from a leverage side. Right now, banks are only lending out 55 to 60% leverage, maybe 65 if you've got a really good balance sheet and a good track record, which is a good thing in my opinion, because right now it's not a time you want to be using too much leverage based on what's going on in the economy. Let's talk about the fourth and final one. And let's talk about the tax benefits of passively investing and why this should be one of your principles. So a question I get all the time is, are there tax benefits from passively investing? And the answer is absolutely yes, there are tax benefits. So before I start talking about this stuff, let me preface in this note I put here at the bottom. You should always talk to your CPA or tax advisor to discuss your unique situation, because everybody's situation is different. Some people are full-time real estate investors. Some people are full-time business owners. Some people are part-time business owners. Some people have full-time W-2s. Some people are retired. Some people have a lot of money in their bank account. Some people have just enough money in their bank account. Everybody's situation is different. So these are kind of broad umbrella things I'm going to talk about here today, just kind of generally speaking, but it may or may not apply to you depending on your situation. But let's just kind of talk high level. First of all, when we're buying these commercial real estate properties, one thing we're doing is called a cost segregation study. And a cost segregation study essentially is a study that we get done by a third-party company that we pay to come in and to help us do accelerated depreciation year one. They're going to come and calculate the value of all the assets that are on our property. So the light fixtures, the light switches, the carpet, and they're going to say, hey, how many years does this have left on it? Some things are 5 years, some things are 10 years, some things are longer. And we're going to be able to accelerate depreciation so that we can pass on those losses to our investors, to all the parties involved to the deal. So you get typically a pretty hefty amount of accelerated depreciation year one. It was 100% prior to 2023. There's currently a rule in place on a step down period. And this year you can get up to 80% of accelerated depreciation year one. It was 100% prior to 2023. So all that means is that you can accelerate your losses up to 80% in year one. So if you, just kind of hypothetically speaking, if you invest $100,000 in a deal and there is $100,000 worth of losses, where you can carry $80,000 of that onto your passive income losses, right? So that's something that's really important to learn, and everybody's situation is different. And as far as being able to use those losses, it's really important to highlight that 9 out of 10 people, unless you're a real estate professional, and that's a tax designation, unless you're a real estate professional, it only applies to your passive income. So you cannot use your passive losses from investing in one of these deals against your active W-2 income, unless you or your wife are a full, or your spouse, I should say, are a full-time real estate professional, and they have to meet the tax code designation of that, right? So what that means is that the depreciation, the losses you're going to show on your documents will apply to all the passive income you're generating, right? So if you invest $100,000 in a deal, and that deal you'll run has a $7,000 preferred return or $7,000 cash flow, let's just say, hypothetically speaking, year one, you're going to get $7,000 in dividends. Well, you're going to be able to show a loss on your your passive tax losses year one, because that depreciation is going to apply to that $7,000. So that $7,000 that you earned in passive cash flow is tax deferred, because we get to apply the depreciation on top of it, which makes it look like it had negative losses, right? So again, I don't want to talk too much about it. It's definitely important to talk to your CPA. And we'll try to bring some guests on to future episodes so they can talk about it. They're subject matter experts, but there are tax benefits for investing due to cost segregation and appreciation. Other things I want to highlight are the opportunity to 1031. So this is more for active investors, but it is technically possible that passive investors 1031 as well, if everyone decides they want a 1031, which is really challenging. It's very, very, very uncommon. So this more applies to active investors, but it is an option for an active investor to say, sell their portfolio and 1031 exchange into a passive investing opportunity. So, for example, it's not uncommon that, say, somebody owns a 20 unit or 10 unit property. They're selling it. They've owned it for a long time, and they've got millions of dollars of profit that they're making, and they don't want to pay taxes on it. They want to defer those taxes. They don't want to pay them today. Well, they can do a 1031 exchange into one of our passive investing opportunities, as long as it's checks the right boxes. We'd have to have a conversation about that. And they can defer the taxes by passively investing in our deal, right? So there are 1031 exchange opportunities where you can come into these deals as a passive investor through a 1031 exchange. And the last thing I want to make sure I highlight on here from a tax benefit standpoint is you can actually use vehicles like a self-directed IRA or self-directed 401k to passively invest in these types of opportunities. That's another conversation for another day. I definitely want to do a webinar about self-directed IRAs and how you can leverage them to passively invest in your deals. But it's a very powerful tool to take that income that you have and move it over to a self-directed IRA, and to use it to generate passive income by letting the IRA passively invest into our projects. So again, I just want to highlight, always talk to your CPA and tax advisor to discuss your unique situation. Now that you know these four principles, right? The four principles that we covered is making sure that you always preserve your capital, making sure you're always investing in deals that cash flow, making sure you're always investing in deals that have equity upside, and making sure you try to find deals that have the best tax benefits. Well, now what? Now what do you do? Well, now it's time to actually invest, right? It's time for you to get started investing. So let's take a look at some numbers here and what it might look like if you decide that you want to passively invest in one of these deals. We're going to use very generic numbers and some generic assumptions. This is really rough math here. Obviously, every deal is different, but it'll give you a little bit of a bird's eye view or a little bit of a preview on what these types of deals, how these deals work, and how it can help you become financially independent and retire early through cash flow. So let's look at the math on the first 5 years of investing. So I want you to just stop for a second. I want you to think about the next 10 years. Think about passively investing in private commercial real estate deals with firms like Headway for the next 10 years. Ask yourself, how do I get to my number? How do I get to my financial independence number through passively investing in real estate? Now, if you're a savvy investor, you likely have other things going on. You're probably well compensated. You might have a great 401k plan. Maybe you have an IRA or self-directed IRA. Maybe you've got other types of investments with a financial advisor or in the equities market. So this is another layer. This is another thing you're adding on top of it for diversification, right? So what does the math look like over the next 10 years if you invest in these types of projects? So we're going to break this down. Let's start and kind of explain this chart. So on the left here, you'll see this is talking about the investment. So let me go back. It's talking about the investment. So if you invest the number that you would be investing each year, so you'll see if you invest $200,000 every year for the next 10 years, that's what this line means. Let's assume every deal has a 7% preferred return, just kind of average. Some might have 6, some might have 8, some might have 9. It just depends on the deal. Well, let's just assume you're getting 7 to use easy math. If you invest $200,000 year one, so let's just say that's 2 deals, right? 2 deals, you invest $100,000 each. Or maybe you want to invest in 4 deals for a little bit more diversification. You invest $50,000 in 4 deals, right? 1 deal a quarter. Let's just assume they're paying 7% as a return year one, kind of average, right? You're going to get $14,000, right? So if you take $200,000, you multiply it times 0.07, you've got $14,000 in annual cash flow. If you divide that by 12, you'll see your monthly cash flow from this $200,000 year one is $1,100. It's $1,167. Let's assume you do this every year for the next 4 years, right? So year 2, you invest another $200,000 at 7%. Well, now you're getting double, right? You're getting $28,000 because you got $200,000 invested year 1, another $200,000 invested year 2. Now you have a total of $400,000 invested in each deal. And if they're paying 7%, now you've got $28,000 in annual cash flow, which is $2,333 a month. So if you follow this chart, you'll see by the end of year 5, you will have invested 2, 4, 6, 8, $1 million. You have $1 million invested, right? Assuming all your deals are paying on average of 7%. By the end of year 5, you have $70,000 in annual cash flow coming in, right? If you divide that by 12, you're getting a little over $5,000. I'm sorry, right under $6,000 in monthly cash flow every month. Now, I want to make a note here. A couple of things I want to highlight. One, this does not include equity appreciation, right? You've still got equity that this does not reflect here at all. So when these properties sell, you're going to get a big lump sum payment, right? That's not reflected on this chart at all. We're going to assume it doesn't exist. We're just talking about cash flow. It also doesn't talk about any tax savings or benefits or deferred taxes benefits you might get from investing in these deals. We're just using easy math here. Let's also assume that all these projects that you invest in, so you invest in 2 projects a year, so you have a total of 10 projects you're invested in. Let's assume that they all have 5-year business plans, which is, I would say, the industry standard for private real estate investments. It's what we do here at Headway. We have 5-year terms. Well, what happens at the end of year 5? Right at the end of year 5, the 2 deals that you invested in year 1, right, $100,000 each, those are going to sell. In year 6, the 2 deals you invested in at year 2, those are going to sell, right? So these deals are going to start falling off. It's what I like to call the conveyor belt. Let's take a look at the next 5 years, right? So you've got year 1 through year 5. Let's look at year 6 through year 10, right? So let's assume that the previous asset sells year 5 and you reinvest your original $200,000 and $100,000 in profit. So let me back up here. This deal that you invest, these deals that you invested in year 1, let's say it's 2 deals, $100,000 each. At the beginning of year 6, they're going to sell, right? They have a 5-year hold. In year 6, they're going to sell, where you're going to take your original capital, which is $100,000 each, and then $200,000. And then you're going to add $100,000 of the profits that you get on the exit, right? So remember, when these deals sell, there's going to be equity on the back end, right? There's going to be a big pop you get at the end for the investment, right? So let's assume you add $100,000. A lot of that, most of it should be profit, if not all of it. And there should be some to stick in your pocket. But if not, let's just assume you add $100,000. And whether that means you get 80 on the back end and you have to put 20 out of your own pocket, or you get more than 100 and you only put 100 in. Let's just assume you're taking your original principal and you're adding $100,000 to it. So now you're investing $300,000, right? You're recycling your money at this point. So year 6, you've invested $300,000, again, 7%, and we should be getting $21,000 for year 6, right? Just for that one deal. So you can start to see over time, as we kind of go through that exact same principle, as these deals start to fall off the conveyor belt, what's going to happen to your cash flow, right? You're going to start to get substantial amounts of cash flow. And this doesn't even show the type of equity that you have saved up, right? And all these deals that you have over $1 million by the end of year 10 of equity working for you. You have 3, 6, 9, 12, 15, $1.5 million of equity at work by the end of year 10, paying a 7% return. That's over $105,000 of equity, right? Again, the goal here, and this is very broad, these are really rough numbers. This is obviously no guarantees of return. The goal here is to just show you how compound investments, investing over and over again, and using realistic timelines. Real estate is not a get rich quick game. It's a constant investment vehicle it's an investment vehicle you have to constantly be investing in, right? So if you're investing $200,000 a year, or even if you double these numbers, if you go to $400,000 a year, or if you cut them in half and you go to $100,000 a year, right? You can start to see the type of impact that constantly investing has on your personal cash flow and your personal portfolio. So the key message I want to leave here with you as we kind of wrap up today and start to take any questions that we have is I want to make sure that you understand these 4 principles and that you invest in quality deals that have a balanced approach. You want to invest in deals that have cash flow, that have equity appreciation, because this is how you achieve FIRE, financial independence, retire early, by truly creating generational wealth. Again, invest in balanced deals. Really, really, really important. So let's look real quick at some headway investments and some opportunities that we've done in the past that are balanced. You'll kind of see here, these are 3 deals that we've done in the past. We've got the Edge, La Plaza, and a car wash portfolio, different asset classes here. We've got 2 multifamily, 1 car wash. You can see the year these were built, where they're located, how many units they are, and what type of cash flow you're getting from each one, and our equity multiplier. That's just our goal here. So like in the Edge, for example, you invest $100,000. It has a 2x multiple. You're going to get a $200,000 total return. That's going to be the sum of the cash flow that you get. So on these slides, for example, we're talking about cash flow, right? So it's going to be the sum of these cash flow plus the equity upside that you get in these deals, right? So you can very quickly see how, again, at the end of year 5, when we sell the Edge, when it sells, you can take the $200,000 that you've made from the cash flow plus the equity upside, and you can reinvest into another deal, whether it's a deal over here at Headway. We'd love for obviously you to reinvest with us, or it's some type of other investment opportunity that's in front of you. That's the best way to build wealth. So I want to leave you with these questions that I want you to think about as we end this webinar. Do you have your investing principles outlined? If you didn't have your investing principles outlined prior to this webinar, hopefully now you do. Remember, the 4 investing principles, if you want to build wealth through real estate, are always go for capital preservation. Make sure you're investing in deals and projects and asset classes where you can preserve your capital. Always look for cash flow. Cash flow is king. Always make sure you're investing in deals that have appreciation and equity upside. You want to invest in things where you can make money on the back end through forced appreciation, ideally. And the last one is try to invest in deals that provide you with some sort of tax shelter, some sort of tax benefits. I'm not going to say these are tax-free investments, but they can defer taxes so that you don't have to pay the taxes today on the income you receive, right? So really, really important. You're looking for those. Know those 4 principles. Second question is, are you chasing cash flow, equity, or both? Really important that you answer this question before you make an investment. If you're not somebody who's that concerned about cash flow, maybe you only care about the upside, you only care about the equity. Well, that's okay. Everybody has a different investing thesis, but you need to know that going in. Because if I send you a deal that doesn't match with your investing thesis, doesn't match with your principles, or any other firm does, you can very quickly say no. That way you don't have to waste your time looking at something that doesn't match your goals. And then the last question I want to leave you with here is, how much do you need to invest for the next 5 years for you to reach your retirement goals? And how much do you need to invest for the next 10 years to reach your retirement goals? Go back and do some calculations, right? Kind of like the chart I showed you. Do some math on how much equity do you need working for you to reach your retirement goals. The average person is probably looking for at least 6 figures of passive income by the time they get closer to retirement. They're going to want to get $100,000 or more in passive real estate income, because they've probably got their equities portfolio, they got their 401k, and maybe they've got a pension. And that $100,000 is a nice big chunk of that, right? So easy math says that if you want $100,000 of passive income at 7%, if you're getting a 7% return, you need around $1.5 million of equity, of capital at work for you in order to generate that $100,000, right? So you need to figure out what your number is. You need to figure out what your financial independence goal is, and work backwards from there. That'll tell you, how many deals do I need to invest in for the next 10 years? How much cash do I need to invest for the next 10 years? Is it a $50,000 a year? Is it $100,000 a year? Is it more than that? If you have a big number, you want to retire with $200,000 or $300,000 or $500,000 of passive real estate income. Well, guess what? The best time to start is today. You need to begin investing today, because the longer you wait, the longer you kick the can down the road, you're not going to have the opportunity to let the snowball build, which is what I was showing you on these previous slides. You really need to let the snowball build. Just real quick, as we wrap up, before we jump into questions, I want to highlight our Headway Debt Fund that we're about to launch on August 9th. It is open for investment, but we are going to highlight this investment opportunity coming up here in a couple of weeks. So if you are interested in the Headway Debt Fund offering, scan this QR code to sign up to visit our landing page over here and to get more info on our website. Please note, this is a 506c offering for accredited investors only. It does have a $25,000 minimum investment. Anything less than $100,000 has a 6% coupon, 6% dividend that we pay every month after 90 days of investment. And anything over $100,000 investment has an 8% dividend or 8% coupon that we pay our investors. There is no equity upside in this one. And the tax benefits are much different. So just to kind of go back to the principles that we talked about, if you like monthly cash flow and you just want to take a little bit of extra money and put it in something that's going to give you monthly cash payments, and you're not worried about all the equity upside and tax benefits and things, then this is a great opportunity for you, because it's going to pay a monthly dividend to you, and you can pull your money in or out at any time within 90 days. So you send us a message, say, hey, Brian, I'd like my $100,000 back. Once you send me that message, you will get your money back in 90 days or less. So great opportunity. If you want to join our private investors club, or you want to schedule a call with me or somebody on my team, you can scan this QR code here. And then if you want to request an invite to our private investors club, you can scan that QR code on the right. Our investors club is something that you do have to apply for. We take applications for this, and we have to get on what we call a qualification call to make sure that you are a good fit for the investing club and we are a good fit for you. We don't want to work with anybody that doesn't align with our investing thesis, and we don't want to waste anybody's time either, who doesn't want to invest in the types of deals that we do, right? So, but if we have this call, if you're not a good fit for us, we can always point you in the right direction. But this call is necessary so we can have a conversation to make sure that you're qualified to invest in these deals, because they are for accredited investors only, and that you are a good fit and you're ready and willing and able to invest. So scan that QR code on the right, fill out the quick application, and somebody from our team will reach out to you to schedule a call. So I want to jump in now to Q&A. If anybody has any questions, please put them in the chat. Now we'll go ahead and answer some questions. Open up the Q&A box. All right. I guess I did a good job today. I'm not seeing a lot of questions come in. So, I got a good one here. Which of the 4 principles is most important to you? Oh, that's a good question. So everybody's different. So this is why there are 4 principles. And I want to highlight that not every investment is going to check all 4 boxes. And that's okay. If it doesn't check all 4 boxes, that doesn't mean it's a bad deal. It just means that you have to ask yourself, does it meet my personal investing principles? So I will tell you, as somebody in my age and my life cycle, where I'm at in life, I really value cash flow. Because I want to get to a point where once it's finally time for me to hang up, the suit, so to speak, and to retire, hopefully early, I have enough cash flow coming in from my passive real estate investments that I don't need to worry about ever having to go forced to go back to work. Now, if I was in a different situation and cash flow was an issue, probably wouldn't care. But for me personally, I really value cash flow. So I don't ever want to personally invest in anything that doesn't pay me either a monthly or quarterly dividend. The only exception to that I would ever make is if it's a very short horizon. So for example, if it's a 12-month project or a 24-month project, or maybe at most a 36-month project, I would consider investing if I don't need the cash flow. But for me, it's really important based on where I'm at, my lifestyle. I like getting that mailbox money. I like getting those monthly ACH notifications from my bank saying, hey, Brian, you've received your monthly dividend payment from X, Y, and Z investor. I mean, that makes me feel good. And it makes me feel accomplished that my money's at work. So personally for me, out of the four, I like the cash flow one. That's my favorite one. All right, let's see if there's any other questions. Question about let's see. Nope, already answered that one. All right. Looks like short on questions today. I only had one come in. So we'll go ahead and wrap up. Just want to say thank you to everyone for attending Legacy Wednesdays. If you want to reach out to us, you can reach out to us at headwayinvestment.com. You can message me directly at brian@headwaycapital.us. I would love to schedule a call with anybody who may be interested in continuing this conversation about building a plan for you and how you can create generational wealth and passive income through commercial real estate investments. I look forward to hopefully talking to all the investors that have joined this call, and we will talk again next week. See you soon.